we're in the accumulation phase and we can dollar cost average. The difference between average returns and actual returns is less impactful.
This gives you the benefit of dollar cost average. So
It
you're
does.
getting the benefit when the market's down, you're getting to buy things, at a discount. What I love about what we're going to get into is we're almost taking that to the next level and not just saying this one thing, but we're looking at ripples on your portfolio.
And so that's when it really gets dangerous. When we start pulling money off of an account, the difference between the average and the actual accelerates. It's much bigger difference than it is during the accumulation phase.
How does Todd factor that in when you're talking to somebody about the pros and cons of paying taxes now versus deferring, postponing to an unknown date at an unknown time?
Disease is caused by stress, right? And is that a time in your life where you really want stress, or would you like the freedom of knowing, hey, I can count on this other asset and it's going to reach in there and pad those down years on the other side? What does that do from you from a stress health standpoint that's not even in the numbers, and yet it is? Why are we saving money? Are we saving it to pile up money, or are we saving it to have something to spend in the future? And it's interesting, if we're saving it to spend in the future, then why is everything about what we're piling up instead of about that stream when we get to that end, right?
All right, everybody, we're going to continue the series with Todd Langford, the founder of Truth Concepts. And in today's video, we're going to be talking about this concept of the ripple effect. And like anything, it might be easy to compare one asset versus the other, but a lot of times we're missing context. And that context might be something that we don't think is a big deal, but they have ripples and it compounds. And so without further ado, Todd, welcome back to the show. People have been loving the way that you articulate different concepts. They've been loving the calculators, and just very grateful to be doing this series with you and really bringing numbers and backing up statements that may be true, may not be true. And I think today's video is going to be technical, but it's going to be worthwhile for either the consumers that really want to understand this, or for the financial professionals that really want to take that next step to be able to really serve their clients at a high level.
Thanks, Caleb. Thanks for having me. And yeah, I think that, we need to talk about the context around this because it does get a little bit technical as we go through the numbers. But I think the other side of it is there's not enough numbers to support some of the things people are saying. And the reason there's not is because a lot of the stuff's not true, right? And so let's talk about this from a contextual standpoint first, and then we'll take a really deep dive to show that what we're talking about is actually truth and that can be proven out numerically. Because if it can't be proven out numerically, how true is it, right?
Yeah. I love that framework.
So when we talk about ripples, one of the things on the surface is to think about what happens when people compare assets in the marketplace. And many times those comparisons don't include all of the ripples, only the ones that support the argument that somebody wants to have everybody believe, right? And so we have to include all the ripples of every decision, both the good ripples and the bad ripples, to really see where we are and keep everything on a level playing field so that we're actually making a valid comparison. And so typically, if we think about a portfolio, right, of equities, typically, in order to follow modern portfolio theory, we're going to have a portion of it's going to be in equities, a portion of it's going to be bonds. But what everybody hears is, oh, well, the S&P has done, somewhere close to or in excess of 12% for the last 40 years. And that's what everybody has in their head as like a benchmark. If an asset or an investment isn't doing 12%, then I could always beat that with the market. But there's ripples in that 12% that are left out, right? That is a gross average return that's happened. And we're going to dig into that and look at what averages look like. But there's other components there. There is the component of taxes that have to be paid. There's a component of fees and commissions that come directly off of that return. And a big one that I don't think you ever see, and that is the certainty asset. Right? That supports that modern portfolio theory. And that's the bond piece. And what that does to the overall return is kind of left out.
What I want to point out is in bringing up the ripples conversation, this is very much like the funding calculator on steroids. It's like the funding
Right.
calculator very much is meant to look at whole life insurance and compare it to potential other assets and to get you to start thinking of like, okay, when you look at something like an internal rate of return, it doesn't necessarily share the whole story. What I love about what we're going to get into is we're almost taking that to the next level and not just saying this one thing, but we're looking at ripples on your portfolio and all of that when it comes to unpacking that story. And so that's where I didn't want to necessarily interrupt, but I want to like set the stage of some of the things that you're talking about, as it's hard to sometimes compare this asset versus that asset. And then when you start adding it to a strategy or a portfolio, it can potentially even get more complex.
Absolutely. Because, in line with exactly what you're saying. Now, we've got two different type of assets when we're talking about a life insurance policy and our investments in the equity. The life insurance policy is a savings vehicle. That cash value is really a savings vehicle. People want to combine it and they want to do that comparison with the marketplace, and it's really not an accurate piece. But when we look at that and we think about the ripple aspect, it's kind of interesting because the numbers that we hear typically on a return of life insurance policy, the cash value over 30 years or so being in the 4.5% range. And people are trying to compare that to the 12 on on the equity side with the S&P, and that's not, we can't compare that because those are two totally different assets. But if we go on with the ripple piece, when we hear that 4.5, that's net, that's after the annual taxes, that's after any commissions and fees that haven't been taken off the 12% on the other side. There's also additional ripples that end up getting left out when we're looking at the life insurance side, and that is the death benefit that comes along that's included in that return, and potentially waiver of premium disability benefit to make sure that that savings vehicle actually completes, right? That even in the event of a disability. And so you've really got some differences. And as you added the strategy portion, how does that fit into the strategy? Does one of those assets actually take on and do more than one job that can't be seen unless we really pair it up in somebody's financial world?
I love it. All right, let's dive into the math, and I'm excited to follow the logic.
Okay, so hang in there with me as we go through this. You may have to watch it a couple of times for it to really sink in. But what I want to start with is, let's just look at 40 years, and we're going to look at 40 years of the S&P. And so we'll go to the market history, and we're going to look at the last 40 years of the S&P with dividends, which is arguably the best of the best, right? There haven't been many personal fund managers that have beat the S&P over time. Maybe in 1 or 2 years here and there, but over the long haul, it just really doesn't happen. And so when we look at this, we see that the average for the last 40 years is 12.62, right? Now that's made assuming that average happened every year. But as we know with averages, there's ups and downs. My mentor, Norman Baker, used to tell a great story about averages, and I think it was right in line. So as Kim's copying these numbers for me, we'll talk about that. And anybody who knew Norman knew he didn't take on a lot of exercise, but his wife, Peggy, was a pretty good runner. And what Norman would say is, Peggy and I average 40 miles a week. Right? She does 80, I do none, we average 40. Okay, well, that doesn't really work out. And yet that's the way averages are seen many times, right? And so if we take this and we look out over time, and we look at 40 years, and it's interesting. So that was, let's use the fixed rate first. And that was 12.6. Is that what we saw there on the average?
Mm-hmm.
If we look at 12.6, and let's put in, say, a current value of $300,000, and let's look at savings of $20,000 a year added. Now, over this time frame, that's a huge number. We've got $55 million out there at the end, right? But that assumes we earn 12.62% every year. Now, let's shift that and use the actuals that occurred over the last 40 years and see how close it is to that number rather than using the average, which is just the sum of those added up divided by 40 years. So if we switch that to the variable rates and use that fluctuation, now it's 32 million. So that is a massive difference. Look at the relationship between those two. And yet, what we hear about the market is always the averages. It's averaged this over time, but the real returns were, a little over half of what the average would actually return.
And a point that I want to make is anytime we do assumptions or people are like, hey, just assume this, they always use the average rate of return. You always say like, hey, assume an average of 12%. And what you're essentially saying is just use 12% because that's the average and you're making that assumption. But this would be a big difference if you assume the average versus what you actually got in that same time period. And so I think that's a wonderful picture.
Yeah, and so it really is a massive difference. And yet, what's interesting, and we won't go into that today necessarily, but during the accumulation phase, which is what we're talking about here, we're actually adding money to it. We're not pulling anything off of it. During this time frame, this difference is much closer than what happens during the distribution phase. And so that's when it really gets dangerous. When we start pulling money off of an account, the difference between the average and the actual accelerates. It's much bigger difference than it is during the accumulation phase. So this is closer to being right. And that tells you how far off it can be during that distribution phase.
Todd, is another way to say this gives you the benefit of dollar cost average. So
It
you're getting
does.
the benefit when the market's down, you're getting to buy things, at a discount. And so whereas if we go down the mountain or in distribution, those work again. Like you don't get those extra cushions. Is that another way to be able to say
Yeah,
like,
that's exactly right. And
okay,
if you think about it, it's kind of like this. During the accumulation phase, we have a down market, but we still have those assets. So when the market recovers, it comes back up, right? But when we're in the distribution phase and we have to eat every day, so it's not like we have a choice. No, we can't, we're not going to pull money out because the market's down. What happens is when the market's down and we have to take money out to live off of, now then the recovery of the market didn't fix those dollars. We
that's right,
lost them. So it
that's
really
right.
hurts them.
Okay, I love it.
All right. So we can see a big difference there in what happens. But let's look at dollar cost, or I mean, at modern portfolio theory, where we're having to have a certainty asset in the mix, typically bonds, right? And so what I want to do here is shift this, and I'm going to use a 50-50 split. There could be, depending on somebody's um, risk aspect, they might be 60-40. In other words, 60% equities, 40% bonds. It might be 50-50. It could be all over the board depending on somebody's risk tolerance. But let's do a 50-50. So 50% in bonds, just to keep things kind of simple, and 50% in equity. So we're going to cut this in half on this side, and we're going to use the A part of this calculator as the equities portion, which has the S&P in it. And then we're going to go to B, and we're going to put the other 50%, so 150,000 out of the 300 and $10,000 a year going in here, earning a flat 4.5%, which is actually higher than what bonds are doing right now, right? And now, if we go over to both and see what those look like as a combined asset, and we rebalance the account every year to keep it in those 50-50 ratios, because what happens is if we don't rebalance every year, then the equity side is going to be out. It's going to have more than the bond side and be out of balance. So with that, look what that did. And this is so left out. That knocked this down to $12 million by having that bond portion in there at 4.5%.
Hmm.
And this is part of the portfolio. It's one of those ripples that's really never talked about. I mean, I don't know of anybody that would have money just in equities without that other portion. I mean, it could happen, but that's not normal. And so usually it's a portfolio that consists of both. Pretty
And
amazing. We've gone
in
from
your in
55
your
million.
in
What's
your
that?
scenario, do you see 50-50 being a common? I know that that's for easy for right now, but like, what do you see commonly?
Yeah, or 60/40. Let's use 60/40. It'll make this look a little bit better. We can go back and adjust that. So let's go to the A side and we'll use 180,000 and let's use 12,000. So that's going to be our 60% split going to equities. And then on the bond side, we'll use 120,000 and 8,000. Okay. So here's a 60/40 split. Now we look at both. We're actually close to this. Oh, we need to change this up to 60/40. And now we see that pushed us up a little bit, and that's 15 million. It's still a long way. And see, what did everybody hear in their head? And that's what gets so confusing in the media. It's like, well, 12%. And so you hear a lot of people saying, well, if the S&P is averaged 12.6%, surely I can do 10,
Hmm. Conservatively.
right? Without even thinking about it. And yet what happens here is 12 is 55 million. The reality after a 60/40 split with bonds, assuming they could do 4.5% every year, and this is before taxes or commissions yet, we're down to $15 million. So we've cut it to less than a third. And that is just amazing. And it's one of those ripples that's just normally not in the conversation at all.
Hey, it's Caleb Williams here. I'm just interrupting this video quickly to invite you to check out our And Asset Vault. You may have been there. We've actually revamping it. And if you are somebody that wants to learn more about, is life insurance the right fit for me? Does this And Asset make sense? Like, does this actually help me be more efficient? We've put together a 10-minute documentary style video that I think does a really, really good job giving the history, why the And Asset, different setups and designs that we use. And then we have an And Asset Vault that gives like case studies, calculators, handbooks, and so much more. We are here to serve you, whether it's a conversation, whether it's education, or the video. So make sure to go check out andasset.com/vault to learn more.
Yeah, that's I appreciate you laying this out. And part of me, when I look at this, is it it's important to rebalance. It's important to do this, but when you look at it in hindsight, you would almost be better off going all in equities. I don't know your thoughts on that. Obviously, it's like we don't know what the next 40 years are going to look like, and so that's why we create diversification to begin with. But what are your initial thoughts on that? Because I know when we talk about the distribution phase, there's reasons why we have safe assets.
Right. And we need that side in the portfolio. I think just most people don't realize what kind of damage it does to the overall return, in order to provide that piece of certainty that's in there. And I think we can, as we get to the end, we'll make this better. But I think it's an important piece, because if we go all equities, the problem is, when are we going to need the money? If it's in a downturn, that's a problem. We don't have something to carry us over. And I think for most financial advisors that are advising on those portfolios, there's some trouble that they would get into if they had somebody exposed with 100%
Totally.
of it on the equity side.
Totally.
So,
So yeah,
they're not even allowed to do that.
I'm tracking so far, and it's so far we're starting to see the ripple effects of just different decisions.
Yeah. So let's now, like I say, we need to add those other ripples, which are taxes and fees, right? And so if we go back to A, and for this individual, what I'm going to use is, let's say they're in a upper end 28% bracket, and they've got some federal income tax, some state income tax as well. But some of this is going to be treated as capital gains. Some of it's going to be regular income, depending on how the long these stocks are kept inside of the funds. So I just want to use a blended rate of 20% on taxes. All right. So if we use 20 here, and then let's do the same thing on bonds, because some of it could be taxed at current income, but some of it might have some municipal bonds in the mix that are tax free. And so we'll use 20% there as well. And let's see what that did just on the taxes. So that brings us down to $7.8 million.
It's crazy.
It really is. I mean, the first time I saw this, going through it with the numbers, it was like shocking to me. I knew it would have an impact. I just didn't know it would be to this degree. And then, in order for somebody to, keep this fund balanced, to do all the buying and selling inside of it, we need a fund manager that's going to charge us at least 1.5 points. And so let's put 1.5% on fees on both the equity side and on the bond side and see where we are overall. And so what we see is now that's brought us down to $4.6 million. And the devastating part of this, what somebody saw in their head, what they were thinking if they'd ever put a financial calculator to the calculations, based on that 12.6%, they were, 55 million. It's like, well, I don't really need to do any
Yeah.
planning, any financial strategy, right? I could mess up and I'm still great.
Yeah.
And that's the devastating part about some of this, is because now when we look at this scenario down to 4.6, understand that they had to earn that 12.6 in the market on the equity side to do this 4.6, which brings us down to just short of a 5% return at 4.98%, basically, is what we're doing over that time frame.
Yeah. That's really eye-opening to look at the actual rate of return. And you're totally right. We're looking at a 40-year time period that's pretty positive. I mean,
Yeah.
how many down years total? I mean, we're talking five down year, five potentially.
5 here. What's below there?
6, 7.
7 years. 7 down years out of 40. An average of 12.6. And what we see after we add all the ripples, which again, that's just what's left out of most conversations, brings us down to a 4.99% rate of return.
Yeah.
Crazy. Okay, so what if we wanted to improve this a little bit? What if I were to shift the bond portion, which is really our certainty piece, to something that's more certain, has more guarantees, and is actually more level, is less volatile in whole life insurance? What if we invested that there and just shifted those dollars over? Let's just see what kind of impact, and then talk about what the further ripples might even be from that.
Yeah.
See, here in this scenario, if you think about it, and we won't go to the trouble to add that in there, but if we made this decision to push all these dollars here, how would we protect our family in the unlikely event of a premature death, right? We'd really, another ripple that would happen because of this decision would be we'd have to buy term insurance.
Correct.
Right? Which we would hope to not collect on. That would be pure cost, but it's part of, really, it would bring our rate of return down if we had to figure that in the mix, right?
Yeah, yes, and that's where the funding calculator comes in, because it's like, yeah, you add in term insurance, and now that money's got to come from somewhere, and so we would take it out of the cash flow number, and now you have less money to be able to work for you, meaning your accounts have to work harder just to maintain, which would mean that your actual yield would go down.
Correct. Yeah. So let's see what happens if we were to shift some of these dollars. So if we go to the B and we transfer, so we're gonna use a life insurance policy. So what we need to do is pull in some life insurance values here. And we're going to use the second one here on a 35-year-old. And so this is just an example, but we're going to use multiples of that policy. And so what I want to do first is, what if we just push the $8,000 a year that we're adding to this account each year? Let's just send that instead of into the bond account. Let's just send that over to the life insurance side. So we'll leave what we have in here on the bonds, the 120,000 we started with, and
Mm-hmm.
use it as part of the rebalance. But shifting that over to life insurance, if we go to the both, it definitely pushed up our yield on the bond side. And look what it did here. It raised us a quarter of a point, and we end up with, in this case, 5 point, or right at $5 million of cash, but 5.3 million because of the additional death benefit to go to the heirs. So that pushed us up almost $400,000, right? Just that initial piece over this time frame.
And Todd, just to clarify, you didn't put the 120,000 into life insurance. We just started with the cash flows of 8 grand.
Correct. And
Okay.
it's difficult. That's one of the things about life insurance. Doing lump sums is really hard in a life insurance policy. And so I'm just shifting that. And basically, what the calculator is doing is it's rebalancing with the total of
Got it.
whatever's in the bonds plus whatever's in the cash value of the life insurance. It's treating both of those together as that certainty asset. So on the rebalance, since the life insurance is performing better than the bonds, it's actually
Wow.
having to
Okay.
shift less money from the equities. Does that make
So we
sense?
haven't even factored in the tax benefit of life insurance yet. You're just saying that it's better performing because the life insurance is growing better than the bond assumption.
Well, it's really a combination of both. There's less money in the bonds to be taxed now, so it is automatically going to reduce the taxation on the bond side a little
Understood.
bit. So
Understood.
it's kind of all that together. But could we be more aggressive? Like if we go back to the bonds for just a minute, and we look, we still see that there's like $600,000 in bonds. So what if we shifted a little more than the 8,000 over to the bonds, and we started trying to pay down this account? In other words, just let's over time shift all of the bond money over to the life insurance cash value. And so let's push this up, say to $12,000 a year. Okay, that still leaves $400,000 in the bonds, but again, it pushed our yield up on the bond side considerably. So
Hmm.
let's go on up to 15,000. Still a little bit more, and we see, look, that gets us to 5.3 million. So we're a good $700,000 more at that point, but we still have some room here. What if we go 20,000? Might be too much, but let's see what $20,000 does.
And Todd, the interesting thing is knowing what we know about life insurance. Is there any reason is there any benefit that a bond can give you that life insurance can't? That's my question. I mean, maybe yield short term, you could make the argument, but outside of that, life insurance is like stacked with so many other benefits than the than the bond. Is there any other thing I'm missing? Like, is there any reason why someone would have a bond over life insurance in their portfolio in this situation?
No, I don't understand it because the bonds are an anchor, and it's interesting that brings up another um, bit of conversation. Let's adjust this down. We've actually pulled too much here. Let's switch that to 18,000 because we exceeded what we had there. Let's change it to 18 real quick. Um, yeah, because we had a big drop there. Let's change it maybe to 17,000. Interesting what happened right there. Okay. Yeah, unfortunately, that carries us through, but we end up with a bunch because of the way the market did there at the end. But that's all right. So let's use the 17 because it carried all the way through. But um, but the thing about the bonds are they're a serious anchor to the overall portfolio, but people like it because it has more consistency. When we think about liquidity, though, it's a problem, isn't it? Because if we're selling those bonds before they mature, we're not going to get 4.5% on them. If we don't hold them to maturity, there's issues on that side as well. And so accessing those dollars becomes a problem. It's really not an and asset like the life insurance cash value is, right? And so access to that's a problem as far as being able to still get the return that we're looking for. It's got a poor performance. It doesn't include a death benefit, and it doesn't have waiver of premium. right? And so all of these things we have with the life insurance side. And it's an interesting point when we think about the media's power over the messages that are out there. Because this was just a couple of months ago, bonds actually jumped up only for a short period of time to like 5.3%. And literally the articles that were coming out from the media said the equity market is going to be in trouble now that bonds are at 5.3%. And basically, what they were saying is people are going to shift from their equities account to bonds. So they're going to give up 12 to go to 5.3 because they like the safety potential of the bonds. And yet, that's way less net than what a life insurance policy does. And they'll never say, hey, with life insurance doing a net 4.5%, people are going to shift from equities to to life insurance. They wouldn't ever say that, even though it outperforms the bonds. Isn't that crazy?
Yeah, totally it is.
And so when we look at this, that's way better. And as you mentioned, the ripples. Now, what happens when we get into that distribution phase? If we do this, we're already set up for the cash flow bridge or volatility buffer or whatever language is around that. Whereas what we mentioned earlier was when we're in the accumulation phase and we can dollar cost average, the difference between average returns and actual returns is less impactful. It still had a major impact, right? It went from 55 million down to 32, but it has a much larger impact during the distribution phase because we don't get to recover when we pulled money out in those down years. So what this
But Todd, I just want to underline what you just said. You just said, okay, it doesn't have as big of an impact, but people are saying this is 55 million to 32 million is a big impact.
yeah
Like, I think you like went over that. And I think that point is made exactly. It's like, we're saying that's not as big of a deal as in distribution. So hopefully you like lean in, because this is where diversification, this is where, like, even if you didn't do the life insurance, why you can justify bonds, because of the conversation that we're just about to have. Really, really important that you get that. And I know that these numbers could be overwhelming, but like, I'm telling you, if you can grasp this, you're gonna understand so much about what retirement planning and strategies and what a lot of people out there are trying to accomplish and articulate. And I think you are sharing in math, like you're giving the behind the scenes of like what a lot of people are marketing to.
yeah so what happens out there, this is what we can guarantee: these numbers are not going to match what's going to happen 40 years from now. Okay. I'll just say that's not, but what we know is things are going to be similar, right? And we need room to be able to adjust. So if we know during that distribution phase that the downs are more painful than what we saw here on the ups, in other words, that difference between 55 and 32 million, right? During the distribution, it's way worse. How do we make the best out of that distribution side? And the way to do that is to have an asset like life insurance that we can lean on in those down years. If we have used the life insurance or grown that life insurance asset during the accumulation phase and it made our portfolio better than it did with the bonds, we're also set up for the distribution phase of having a place to go so that we don't have to pull money out of the equity side when the market is down.
Yeah.
Now then we've cleaned up that side and we've made the distribution phase of the when the market drops less painful, so to speak.
I think that was well said.
Well, and there's some great information if you look up Dr. Wade Pfau, PFAU. There is some terrific information. He's done billions and millions of iterations on supercomputers to verify the data of what happens if you don't have that other side and what you can pull out.
Yeah, here's his book here, Safety First Retirement. I said this jokingly in a different podcast. I said, hey, if anyone wants to read this and let me know what it says. And I actually had a person that is a professor essentially at a tech college, computer person, they read this book and gave me a summary, and we had a
Oh,
podcast
nice.
episode. So I'll link that down below. But yes, Dr. Wade Fall has been on the show, very smart, and talks again about what we're talking about here. So it's incredible.
Awesome. Well, this really, hopefully, this wasn't too overwhelming, and the numbers back up what we're saying. What's interesting about it is when we talk about it conceptually, I think it's difficult to see just really how big this is, right? I mean, seeing these numbers grow from 55 million down to 4.6 after we include all of those ripples that come along with that
Yep.
60-40 portfolio is mind-boggling. We're less than a tenth of the account. And people are making decisions, unfortunately, based on hearing that 12.6.
Yep. Couple questions for you. I know we assumed a 20% tax rate on the growth of equities. What someone could say is like this money could be deferred in a SEP, 401k, and all. How do you factor in that into retirement, not knowing tax is going to be like? How does Todd factor that in when you're talking to somebody about the pros and cons of paying taxes now versus deferring, postponing to an unknown date at an unknown time?
Great question. So there's a couple of things that happen, unfortunately, that are really a problem. Like if our equities portfolio is inside of a tax deferred asset, now we don't get capital gains. All of it becomes income tax rates. So that's automatically going to boost it unless we're broke. I mean, the old line of thinking is, hey, we're going to defer these taxes and because we're going to be in a lower tax bracket when we retire. And I think, unfortunately, that language has caused people to think there's a set of tax brackets for retired people that's different than the tax brackets for everybody else. And in the United States, it's not true. They're all the same. It's all based on the amount of money we make. So literally, the only way we could be in a lower tax bracket in the future is if we're making less money. And that's really not something to aspire to, right?
Yeah, welcome to America, where where we reverse engineer how you're broke in retirement, so you don't have to pay taxes.
But we shift. See, right now we have capital gains at a couple different levels, but the beginning level of capital gains is at 15%. Versus what we might be paying in current income tax. But when we put it in the qualified plan, we're deferring that money out into the future, but it's going to come out at full income tax rates. Capital gains piece goes away.
So in other words, the doing what you did is not as favorable for the 40-year net worth number, but from a actual accuracy standpoint, from a standpoint of when we're looking at the ripples on the not just the accumulation but the distribution, it's more fair, would you say?
Yeah.
And that's another thing I just want to point out is everyone is focused on accumulation, the number, the rate of return, and a lot of times we're missing what is the whole purpose of why we're doing what we're doing to begin with. And we're almost like, instead of setting ourselves up for success, we're almost stacking the deck against us in the future.
Yeah, and that's a great point. And we did that here at some level. We were looking at what we have in the future as a benchmark, but really we need to be very careful with that because net worth. When we get to distribution, do we care what our net worth is, or do we care what our income is?
Care about income.
Yeah, we care about what we have to live off of. And so while almost all of the financial studies that advisors give are all about this age at some point, how much money can we pile up? But usually that amount of net worth includes the house, which how do you spend your house if you're living there? How do you've got all these things that are maybe not spendable. And it's very, very possible that with the right tools in place and the right strategy, that lesser net worth could actually provide more income depending on what that asset's in. And so going that full route is really an important piece. Just focusing on when we get to the distribution age and how much money we can pile up, that's not that's not really a complete picture. We need to know what it looks like on the other side when we're pulling those dollars out, because we may be piling them up in the wrong place where they're not very spendable. And so um, comparing that could be certainly a problem, right?
Is, is there anything else that you want to talk about before we talk about like different potential distribution ways down the mountain?
Um, I think being careful and making sure that we're looking at that side. I think that's just the big piece, is getting everything in perspective. And I think you said it really, really well. And that is, what is the purpose, right?
Yeah.
Why are we saving money? Are we saving it to pile up money, or are we saving it to have something to spend in the future?
Yeah.
And it's interesting, if we're saving it to spend in the future, then why is everything about what we're piling up instead of about that stream when we get to that end, right?
Yep. Yeah, couple takeaways that I have from this. Obviously, I love the concept of ripples. I think there's even if like you can apply that to so many areas of your life, health and business. There's a lot of ripples that have consequences. The cool thing about what we're talking about is we can put numbers to it. And I also think we talked about just something really key is like, why would you use a bond? Knowing what we know, because their bond, you lack liquidity in a lot of different cases. You potentially lack growth, and you doesn't include the death benefit, which we don't really even include. We mention, but we don't include like the cost of term insurance over 40 years, or even what like a guaranteed policy would be if we just covered that death benefit. Like that's something that these things compound. But then we also mentioned about the purpose of why we do what we do. And yes, the number is not 55 million, but this is a responsible place to be at. And when it comes to distribution, like my question would be, do you have more confidence taking out more money? And I know this is not retirement advice, this is not investment advice, but do you have more confidence being able to take out or spend more money in retirement having life insurance versus bonds as that blend? I don't know if that question made sense, but like, and you can answer it the way that you want, but like, I'd be curious, like, if you want to maybe cover that in a next video, or if you want to touch on it as it relates to just ripples in this video.
Yeah, no, I think it's a really important piece. And I'm going to go about it a couple different ways, and I'll kind of circle back to the exact question. But um, one of the things that happens is, do we want to be stressed out during that distribution phase?
I don't know.
No. And actually, I think more and more studies are pointing to the fact that, like, I think they're going to find out 90% of most disease is caused by stress, right?
Yeah.
At some level, it's attributing to that. And when people get in this position of, okay, well, we're out there with our equities. Oh my gosh, is it, what happens when the market goes down? How is that going to change my ability to eat? All these things. That is stress. And is that a time in your life where you really want stress, or would you like the freedom of knowing, hey, I can count on this other asset and it's going to reach in there and pad those down years on the other side? What does that do from you from a stress health standpoint that's not even in the numbers? And yet it is. Because if you're stressed out and you're unhealthy, that's going to cost you more money, right, in doctor bills or whatever
Yep.
else. And so that's certainly an issue. But I think too, where that comes back around. So I like to look at, if we have a guaranteed event, and that's what's beauty about life insurance death benefit. And so many people look at death benefit as something that's going to go to somebody else if I die prematurely. And that's absolutely true with term insurance. And it's a necessity, right? We need to take care of our families. It's not to say don't do this. But the problem with term insurance, if you think about it in a big picture, is it's designed to be in place when the likelihood of death is very low. Somebody that's gotten approval from the insurance company out to age 65 or 70, that time frame is a very low risk of that happening. It could, and we need to cover for it, but it's very low. And then with term insurance, we're supposed to get rid of it at that point in time because we obviously can't afford it out into the future. And now it's to a time when death is a guaranteed event.
Yeah.
Right? So we have it when it's unlikely and we get rid of it when it's guaranteed. The beauty of whole life insurance is it gives us that protection in those early phases while it's giving us cash value. And then it's in place, guaranteed to be there when that guaranteed event of death occurs.
Yep.
So if you think about it like this, if you knew you were going to win the lottery at some point in time out in the future, would it change how you could spend money today?
Yes. Yes.
So if I have a guaranteed event, death, and I have a guaranteed thing that's going to happen, a death benefit's going to be paid for my life insurance policy when that happens, I can leverage those two guarantees against each other and bring them back in time, and now know that I can spend dollars in a different way today, a more efficient, a more strategic way today. And that might be accelerating pay down off of taxable assets, which would reduce the tax paid on those assets. There's all kinds of different things based on what the environment is at that point in time. But setting that up early allows for us to be able to take advantage of that out there in the future.
I think that's great. Todd, thank you. Is there any other thoughts that you have as it relates to this?
Oh, always tons of thoughts, but no, probably enough for this lesson this time.
Yeah, I just want to encourage you all, if you're watching and you have questions, please comment below, and anyone that can share this video, it just helps. So if there's other people that you need to share this with that are in our profession industry, or just someone who's like nearing retirement that should just have some different things that they should think about. I know that's maybe another video. We don't like to use the word retirement, but that's the common word that a lot of people use with this concept of shifting from creating value, which that's again a whole nother video that we could dive into, Todd, and see if we could put math to value creation and the theories there. But the point I want to make is, if you are someone, if you are an advisor, if you are in this space of helping people with their money, and you want to learn more about Truth Concepts, we got a link down below. Lots of fun and exciting things happening on the Truth Concept side. And Todd, we just feel super grateful for you spending time with us. And also, if you just have questions that you want us to be able to answer, if you have video requests, please let us know, because we're going to be in a series where we're going to continue to be able to talk about calculators. And I'm going to bring up in the future different ideas that people are having on the internet, and we're going to see if they hold water as it relates to is the facts and truth on their side versus is it just theory. And so, Todd, again, thank you, and I look forward to continuing the series with you.
Cool. Thank you, Caleb. This is an honor, because this is part of our goal, is to change the thought process. We're getting beat up all the time from the media on stuff that's just not true. And, the numbers play that out. So
Sure.